Hello everyone, I'm Mark Sane and welcome to Sane Investment Solutions. Before we begin, please take a moment to pause this video and review the following disclaimer. Thank you for that. We're now going to review, this is week 46, the end of week Forex currency review session. We're going to have a look at the daily FX news for the week and have a look at the Aussie USD share. Well, here we have, this is a daily FX website. What you'll need to do is, for the current time, you just need to change it to your local GMT time, and then you can just add the filter, and today we're only going to look at the high importance news. So at the Forex economic calendar on the Daily FX channel, we can see all the high importance news which are upcoming, and this is very good to know definitely the week prior. So looking at today for next week is a good idea to do, and that way you can see what news may move the markets and which way they could go depending on your fundamental analysis and what you believe the outcome of these news events may be. These news events we are looking at are for this week and for the ending of this week, and we're just going to run through what happened. In the beginning of the week, we had the China CPI numbers came out. They came out worse than expected with 1.3 versus a forecast of 1.5, and that would have affected currencies such as the Aussie dollar, and you would have seen the Aussie have a bit of weakness. Then afterwards came out on Thursday, so we didn't really have much news on Wednesday, and then, or high important news that is. And on Thursday, our local time, the Aussie unemployment change numbers came out, as well as the unemployment rate. This surprised the market because the unemployment rate dropped from the forecast of 6.2% down to 5.9%. That actually saw some strength in the Aussie dollar. So around this time of the news, the Aussie dollar gained some ground against all other currencies, such as it's against the US dollar. You would have seen the Aussie dollar against the US dollar rise. Later that day in that news came out some other Chinese numbers, which were worse than expected, and we probably would have seen a bit of a reverse on the Aussie dollar. And then following that, towards the end of the week, we had some Euro ECB Draghi comments come out, the German GDP numbers come out as well. These were worse than expected, so if you fundamentally were short on the euro, you would have seen the bit of a pullback on the euro. When the Draghi announcements came out originally, you would have seen the euro strengthen, and that would have been probably some of the larger banks and corporations out there just trying to stop out a few people who were heavily short on the euro. But we're starting to see the euro weaken again. And finally, towards the end of the week was the US numbers came out. Now, these again surprised the market with them being worse than expected on the retail sales, but the Michigan confidence numbers actually was better. So we originally saw the US dollar devalue, and then following a few hours later when the Michigan confidence number came out, which was better, we then saw the US dollar go from weakening to strengthening again. So keeping an eye on these news is definitely a good idea at the Daily FX, and you can just see what's coming up and have a feel on which way you think the market might move, and then you can use these news events to your advantage by either exiting a profitable trade, bringing it to break even, or looking at to carry on in your fundamental direction. We're now going to take some time to review the Aussie USD daily chart. Now today we're just going to look at, normally we look at support and resistance levels. Again, we'll look at those on where you could probably buy and sell. Also, one little trade, simple trade that you could probably look at using, and that's something just like looking for the breakout trade of the recent highs and recent lows. So an example is if we were to look back to the beginning of this chart here, back into, I think it was December, somewhere around there, and let's just highlight over it and it will tell us exactly. Yep, no, October. So back in October 2014, if you just wanted to look at some simple trades, you could just go, okay, well, how about I look at the recent lows for the last, we'll say 60 days. So the last 2 months is a good place to look at. And all we do is we just put on our calendar to where the current date was. So if we're currently trading in this session, so therefore we can't see anything forward here, we can only see what's left, you'll just hover over the indicator, slide along, and go back to the first two symbols or letters, numbers, say 60, and that shows that the last 60 candles or the last 60 days of trading. We then look for the lowest point in the market, and as we can see, out of what we can see to the left and to where we started looking with our crosshairs, the lowest point would have been this level here. So we would have just drawn a line there and said, if the market breaks below that line, I'm going to go short, or the highest point, which was roughly back in the last 60 days, was roughly up here. And we go, if the market is going to break above these levels, because this is the highest point in the last 60 days, I'm going to go long. So based on those scenarios, we will just wait in the market and then see what happens, and then bang, this candle triggers. You can see that this red candle, which I've got my crosshairs over, it closed below this 60-day breakout, and therefore you could have taken an entry position there. So if you took an entry position on the candle close of that one and put your stop loss somewhere above recent highs, you might have had a need to about 350 pips, and then you could have rode that all the way down somewhere to down these levels and taken at least 2 or 3 to 1. Here we've made 1,000 pips, so 350 times it by 3 is 1,050, and down here is about 1,050. That's a 3 to 1. So that's a very good risk to reward, only risking 350 to make 1,050 pips. So just an example of how you could use this 60-day breakout rule. 60 days is just a number I've chosen. You can use anything that you seem fit based on your back testing. If we came down to these levels here, and this was our entry position, roughly down these levels here, again, we would just look back and go, well, let's look at the recent lows for the last 60 days, and we would find that in the last 60 days that the highs would have been here, and the lows would have been here, and then when the market closed below it, so it may have triggered on that one there, but definitely triggered on that one there, you could have done the same thing again, gone back and said I need about a 400 pip stop loss. You would have made close to 400 pips here, and that's only a 1-to-1 risk to reward, not as good as this previous move, but then again, these breakout trades generally work as we have a sideways pattern. So as you can see, we've got a bit of a sideways pattern through these months here. So this is the time you would then look at it and go, well, I'm going to look for a breakout, and I'm just going to draw these lines in automatically like this now. But say you're sitting around this level here, and you go, well, I'm going to look back the last 60 days, and the last 60 days is about here. So the highest point for the last 60 days would have been that candle there. And then as you moved across to these candles here, you then have to readjust that line, and you would have gone back the last 60 days again. You're going, okay, well now the highest point is here, and then finally it's broken out. So you would have gone long in this position, you would have taken the trade here, you might have put your stop loss somewhere down here, about 200, 300 pips. You didn't make the 300 pips, unfortunately, and then when it's closed back down through, you likely would have got stopped out or taken a small loss. And then you just keep following the trade along, and as it come along, it's still going at it sideways. So that was a false breakout. It's pulled back in, it's still going through its channels, and roughly around here, we'll say you've looked at it, you've gone back the last 60 days again. Again, 60 is just a number that I've chosen. You would look for your breakout levels, and that's the highest point or the lowest point in the last 60 days. So going back the last 60 days, we can see that these two levels are the highest and lowest points, and this red candle closed below. So then again, you would have taken the position roughly here and gone, okay, well let me have a stop loss of around about 300, 350 pips, and you could have made yourself 600 and something pips. So that's another good risk to reward ratio of risking 1 to make double the money. So in this trade, from roughly around October 2014 to October 2015, in the year, you could have easily made 3 trades, and 2 of them would have been very successful, making a 3 to 1 and risking making 3 times your money and making twice your money, and here you probably would have lost half or maybe your full lot. So you made 5 times here, lost 1 there. That's still 4 times, and that's good trade for that year. Now this is only one pair we've looked at, and there's other pairs you can look at for similar rules, but that's just a bit of an overview of how we would look at a breakout trade. And you can use a breakout trade on all multiple time frames. You can drop down to the 4 hour if you wanted to, and drop in some levels and go on, okay, well, let's quickly just drop in some lines here and go, how about the last 64 hour days trading? You go back the last 60 and we're looking around these highs here. So this would have been the highest point. It's about here, but this is the highest and this is the lowest. And then, we've got a breakout on this one here. Now you might have not taken that trade because you might have thought the breakout's too much, but if you did, you risk about 100, 150 pips. It's pulled back. You should have still been saved unless you bought it to break even. And then you've made about 100 and something pips. So you might have made close to 1-to-1. We're only looking obviously at this very short time frame. If you scroll all the way back, you would have made it on this nice move here. So just taking consideration again, the breakout trades, when we do look at them, breakout trades generally work good when we have a sideways pattern and then we have a breakout either higher or lower. And some people like to trade the breakout trades only in their fundamental direction. And in this case, if you're fundamentally weak, the Aussie, but strong, the US dollar, so you only want to sell the Aussie against the US dollar, you wouldn't have taken a loss in the upside because you would have taken this downtrend here because you're fundamentally short. Then when it confirmed a breakout was higher, you would have not taken that trade because you would have said to yourself, well, I'm short the Aussie against the US, not long, so I'm not going to take that false breakout. In this case, you would have saved yourself some money, and then you took the next breakout lower, and so therefore you would have had the 3-to-1 win here and the 2-to-1 win here with no losses because you've only gone in the fundamental direction of the Aussie being weak and the US being strong. So that's some good things to consider if that's the way you like to trade, using a bit of technical with a bit of fundamental. So I hope this breakout trade sort of works for you, and we're probably going to leave this session there. Well, thank you for that. I hope that session was enjoyable for you and you learnt a little bit from it. Again, I'm Mark Sain from Sain Investment Solutions, and I wish you all the best in your trading. Take care. Bye-bye.